So this company is present in the water management sector, and there are multiple things which happen, like the whole water treatment. There are treatment activities. Then there are a lot of utility sector water management activities. Then you need to purify water, and you need to have certain kind of chemical resins and all which are applied for water purification. Or there is a wastewater treatment which needs to happen, or there are many industrial manufacturing plants where there are certain recycling and zero liquid discharge which needs to happen. And in the residential home, everybody needs to drink purified water, so the whole RO concept. And then there are sewage treatment. So there are multiple things which happens in terms of water management. And this company is present across all, and in B2C, B2B, B2G, in all the segments. So it's a water related business. And if we see in terms of revenue, they're present in three segments: engineering segment, chemical segment, consumer. Engineering in terms of top line, this is the biggest one with 58% revenue share. Second is chemical, and consumer is a very small business. And even if you look at 10-year history, the distribution has more or less remained same, maybe 2%, 3% here and there. Now in engineering, basically these are infrastructure projects where there could be either turnkey projects where they will go, they will design, they will deploy, they will build the whole water treatment plant or wastewater plant. Or there could be O&M contracts where after the plant has been built, as a part of operations and management, they manage those plants. So they provide integrated services and solution in water and wastewater treatment, including seawater desalination, recycling, zero liquid discharge, right from design to delivery stage. And these projects are typically either as a bought projects, or they can do as a EPC contract. And the clients are private companies in various sectors, as well as municipals and government bodies. This chemical business is more where for water treatment, you need different kind of chemicals for water cleaning. So resins and specialty chemicals dedicated to treatment of water, non-water application. And consumer product is typical, the kind of ROs, RO filter, and those kind of things which are required. So this is, they cater more on the B2B side. B2C business has not grown that well, and we'll discuss in detail. But these are the three business segments. Now, in terms of engineering business, so in engineering business, they design, engineer, supply, construct, and provide both construction and O&M services for water, wastewater, and treatment water plants. And these are the industries they cater to. This is important because this is a high working capital industry, and your receivables and cash flows can be very, very bad if you are not dealing with right set of customer. So the municipal and the government business, we need to check what is the distribution, what is the cash flow. So that way, having a private industry exposure and then a diversified sector book is very, very important. I know we started looking at this company more from industrial, but they cater to multiple sectors and industries. And if you look at 10, 11 years of history, only 1 year they went through a revenue downfall. That might be because they are much more diversified. But this engineering segment margins, if you see 17 to 21, they kept on improving margins. And the margins were not that great, 3.4 to almost 3 times improvement. So one key part of analysis is, was this cyclic, and can we expect more fall in the margin, or was it a structural change, and then how much it will fall? So these are the important part of analysis we need to focus, because all of this will change the whole valuation, whether you're looking at it as a cyclic company or non-cyclic company. So those things are important. We will discuss order book in detail. This is more just to get a sense of the business and margins, but we'll discuss about order book in detail with the latest data. So you can see they are executing orders for Sri Lanka, which could be a risk. Then there is one more UP government orders have been added. So we'll discuss more about it. Abhi, I'm just exposing you slowly into each subsegment in detail. And they take these projects on BOOTs, build, operate, transfer, and turnkey is like you build the whole thing and then you pass it on. EPC is like, you don't take the ownership of financing, you get your payment in slab wise and you do. And they do for all these things. Then standard systems are like, they have, pre-engineered things like softeners. So when we have the RO, we have those filters and softeners you can see here. So there are certain things which are required in the plants, and they create these kind of pre-engineered systems. And if any company needs, they go and they deploy it. So that is what they do in the engineering side, industrial side. And these are some of the companies you can look through. So all across segment, like right from big companies to medium companies to pharma companies to auto companies, because everybody in their plant, they need water and they need treatment of water. So that is how, this business works. The chemical business is one where the margins are higher. So if you see the margins, the EBIT margin in engineering business from 3.5% to 11% to currently 5%, versus chemical business where the margins have been 15%, 13%, and now they have gone almost 24% and now at 21% margin. So one thing is there. Each of these businesses, they went through from a static margin to a big margin improvement, and then last year FY22 there has been a margin fall, but every business has been improving margin, and this is almost a 4 times higher margin business. And this is like when you have your water treatment plant, you will need certain chemicals, at a regular level for those wastewater treatment things to happen. And that is where they sell these water treatment chemicals, ion exchange resins, and these kind of things. And these are some of the industries where they're supplying it. Domestic in India, they have 40% market share, they say, and they are exporting it also. And we'll discuss more about export. And they export both to US as well as to Middle East countries. And these are some of the, uses and all the things. So resin is used for removal of color, odor, these kind of things. So basically in water treatment. Consumer business, this has been a very small business. And we all know that, consumer FMCG business, the HULs of the world, they sell it, the Eureka firms, they sell it, and the kind of valuations they get, the kind of growth rate they have. But this company has not done well. Maybe they don't have that kind of, B2C FMCG genes. And you can see, even if you go 5 years back also, it's the same. And I've taken a ad from 2010 when Juhi Chawla used to get ad contracts. So this is from the 2010 annual report. And though they had kind of first mover advantage, zero B and all, they have not been able to do well. And they cater more to the industry side, like, different institutional segments and all, where you have the RO purifiers and water softeners and all. But this business has gone nowhere, and it's a loss-making business. It's a small 8% revenue business. We'll discuss more. But these are the 3 businesses. Now, given we have fair idea of business, and we will have all the questions in the end, so let me just finish it. So if we look at the history, so this is very interesting, because if you take 8 year, 5 year, 3 year, 1 year, it's a 9 to 10% kind of sales growth business. But what they have done better is they have done almost a 2-3 times conversion of sales to EBITDA. So EBITDA growth has been 25, 24, 26, such a high EBITDA growth. And you saw because of that margin trajectory, your 2x, 3x kind of margin improvement, which got converted into ultimately a much higher PAT because of operating leverage of interest rate depreciation and all of that. So almost a 56% CAGR, 40% CAGR, 36% CAGR, and no equity dilution. So they have been able to convert the PAT into EPS. However, the cash flows are not, it is good, we will see in detail, but not as great as, because it's little working capital heavy business. They deal with municipals and governments, but still it's a decent cash flow growth of 37% on 8 year, 8% on 5 year, 23% on 3 year. And they have been able to do this with reasonable amount of asset. So 15, 18, 13%. So with this kind of profit has been achieved with, much lesser asset growth. They have been able to reduce their debt because it's a heavy working capital business. Your working capital growth is proportional to, in fact, higher than the sales growth. This is something we need to track, and actually this is increasing. So we need to see if, they are done with their good quality clients, and are they trying to get into more municipal and government businesses where the receivables are higher, and that is why this is increasing. This is one cause of concern we need to focus. And when we see in terms of profit conversion, so very good, 561 crore of 8 years of profit converted to 874 crores of cash flow from operation. So any timeline you see, it is decent, but you can see the ratio is decreasing, which is reflected again in this working capital data. So we need to be little cautious of this part. But what is more interesting is if you see the cash flows and the capex, all this growth, it's not a very capex heavy business. And I will discuss why and how, but very good PAT to cash flow and very less of capex required. If you see how much of capex they have utilized out of cash flows, hardly 30% of capex. So 70% of your cash flow from operation can be converted into free cash flows. Now, whether they give it a dividend or they invest, that is a different thing. But from a capex asset perspective, I think this is a very, very good business. So all those ratios, of course, working capital and hence high receivables and all of that. But this company has never garnered very high valuation. So if you look at EV to EBITDA, the minimum was almost 4 and maximum so far in last 8-10 years has been 12 and the mean EV to EBITDA has been 7. So we'll see why that and is there scope of improvement. And right now they're at the maximum EV to EBITDA. The question is, will the prices fall from here? Will it revert from here? It is at the highest lifetime high, or has there been structural changes and will market re-rate it? So those are the questions we need to discuss by analyzing the business. And then right now they're working on almost a 10% PAT margin business, which is quite good. This is FY22, but now if you look at last 2 quarters of data, this will fall. So it will go back to 7.5 and 8%. And tax paying, little receivable heavy, working capital heavy. Our balance sheet was very good, 18 interest coverage. So, you know, the debt has been decreasing, cash flow decent. Don't take 1 year number because 1 year there could be gyration. So that is why at least look at, 3-year number, good free cash flow conversion. Sales, we know last 8 year, 5 year is a 10% growth. The question is, can they grow profit higher than the sales now or not? Those are the things. Very decent return on equity, return on capital, and at 18p and all of that. And now when we look at these numbers, so you can see how the company has been able to improve their profit margin from 1% to 8%. And if you see, this company has been a huge wealth creator. See the kind of market cap CAGR it has got, and the company listed from 1977, 8-year market cap CAGR 43%, 5-year 34%. This is the kind of, these stocks, we always talk about Bajaj Finance and Titans, but these stocks never get, that kind of mindshare space, but they have done exceedingly well in 10 years. And why they have done well is basically this whole operating leverage story where even your EBIT margin, core EBIT margin, so I'm not including other income because other income is also a good part. They have good cash on their balance sheet, which generates almost 20% of profit as other income. So I'm taking only core EBITDA just to see the margin improvement and see the kind of margin improvement which has happened over years. So the key is to understand why it is happening. Will it continue in future? And that is where all these numbers. So this is a rolling margin of 3 years. So what I do, this is the annual margin. So I take an average of 3 years. And now by this time you would have understood by having access. So this gives more stability. It makes the data more smooth to get the long-term direction of where the company is going. And then this is the 3-year, 5-year, 8-year average. If we look at the debt equity, you can see, and with this kind of improvement in numbers from a 0.6 debt equity, now they are at 0.2 debt equity. And this time it was like a kind of, mid-risk zone where you could have paid 2.3 years of interest, but now you are in a very decent position. So, everything has improved. The numbers have improved. But if you look at the cash flow, the company from doing a mean rolling 3-year cash flows of 27 crores 7 years back, now they're delivering 130 crore of cash flows. The cash flow to EBITDA conversion was also great, but as I said, now it is coming to a level where I'm getting a little worried, and it should improve. It should not deteriorate. So we need to monitor their books, the distribution of revenue. We need to track the receivable days and all. But very encouraging. What is worrying is, and we will discuss in detail, if you look what they're doing from their cash flows, so 30% of cash flows goes into capex, 10% dividend. So what they're doing with remaining 60% of cash flow, that's an important question. And they're investing. So where are they investing? How the investments have done? Why are they not sharing as dividend if they don't need more money? Those are the questions we will discuss. But this is something which is a red flag area, and I will discuss more about it. But also, this is how we analyze tools. So 16th webinar, we'll discuss in detail with 5 use cases, but this is how I analyze this tool. If you see the ROE, so because of your margin improvement and all of that, you can see a very good improvement in ROE. So the question is, can this company re-rate, or is the re-rating happening right now? Those are the things which we need to discuss. Your ROA is tremendous improvement in the ROA. And if you look at the growth, 3-year, 5-year, 8-year, I think we have seen the numbers, but there's one more chart. So how did it happen? Like, what led to all this improvement? And if we look, so now let's get into financial. So now you know what a engineering business is, what a chemical business is, what a consumer product business is. Now let us get into a little bit of detailing. And if you see the revenue share, so as I said, more or less it has remained same. So it's not a revenue mix change which has happened. That has not happened. The story has happened. So is it like revenue mix change? Not so. It can happen in multiple ways. Either your revenue mix changes and the higher profit product gets more revenue share, or your revenue growths are different in engineering versus chemical versus consumer, or your margins are different. So no revenue mix change, no revenue growth change. So if you see chemical business grows at 10%, consumer product is worse. So 3-year, 5-year, 8-year. The highest growing business is always engineering, little higher, 12%, 8%, 8%, 7%. So chemical grows little slower than engineering, and consumer has been a laggard, and engineering goes at high rate. And that's how the company maintains almost 8 to 10% of growth rate. So this is also consistent, 3-year, 5-year, 8-year. One thing which has happened is, if you look at the export share went from 21% to 42%. This has come down because of maybe a UP contract is bigger, but you know, it's an institutional B2B business, so you don't expect very uniform shares. These things fluctuate, but direction wise, the focus is more on export, and export being a higher margin business. Of course, export has contributed, to a certain extent to the margin improvement. That is one part of story. They say they are a very R&D driven business. They have 2 R&D centers. There are 50 patents converted into 100 products. It's okay. I mean, I don't know if this industry, but 1% is the kind of amount they invest on R&D, and most of them are recurring expenses, which they put on the P&L side. 10-20% gets capitalized, which is okay. But what they have done is, if you look at the margins, the EBIT margin, operating profit margins are very different in these businesses. The consumer business has always been a loss-making business. Last 3 years, finally some improvement, but then it is not a major improvement. This is more a pre-COVID. So they have just reached to the pre-COVID level. So it has still remained a loss-making business. If you look at the engineering business, it used to be a very, very low margin business, very low EBIT margin business, 2.83. Last 3-4 years, they have done well. And now again, it has come down to 5% will deal. So the question is, okay, all of this happened because of this business, but how sustainable it is. But look at the chemical business. This is the business which is the core. So even though revenue wise, this is a 30% revenue share business, the profitability, the valuation, a lot of those things will get driven through this business. And it has been improving. So the question is there operating leverage or not? Is there a raw material pressure can come or not? But this is the business which we have to track, and the big things will happen because of this business. This business might give growth and order book, and this is the whole order book is coming from here. But order book may not lead to that kind of profitability, maybe because it's a high revenue share, it will come. But the financial quality, which everybody will discuss, debt-free and ROCE and all, this is the business which will drive. And if this business goes through a big growth curve, then you can expect, a lot of fireworks here. So this is important to understand. And this is how all that margin improvement has happened because of engineering and this. But this has been like all the improvement in ROE and ROCE and all of that which you are seeing, that is happening more because of this particular business. Now, because we spoke about a very good business from a cash flow perspective, from a capex perspective, but what is happening to the rest of 60% of money after 30% capex and 10% dividend? So see, before working capital, this much cash flow, and you can see very minimal capex, almost 30% of capex, and huge free cash flow. Out of this and this is 10 years of data, out of 622 crores of free cash flow prior to all the other things, 141 crore has been used in paying the interest. And you can see now slowly the debt equity has come down. So going forward, if they are able to manage growth through internal accruals, which I believe they should do because they just need 30%, in future, this number has to be lower, which means there will be bigger question on how they're utilizing it. Okay, so this was one component, and future don't expect it. Dividend is the other component, but out of 622, hardly 10% of dividend payment they have done. And then the cash on the books have increased. So almost now I think they have 500 crore plus cash on the books, which they could use in acquisition or what. And I believe going forward in future, more 100 crore of, this is 10 years. So every year, maybe 20-30 crore more will flow. But there is something called other investments, which they have done of 268 crore. So the question is, all these numbers which we are getting in the P&L revenue, are these other investments contributing or are these other investments deteriorating? If they're contributing, it is good. But if they're deteriorating, then the question is, have you done the right investment or have you wasted 300 crores? And if you just give this money back, then this business will look much more lucrative. Your dividends, everything can go up. And if they're not investing in capex, that means either the business doesn't need capex or they don't have avenues for a better growth. So what they will do with this money, how they have done in past and what they will do in future, that becomes very critical from a re-rating perspective, because many companies who get 20-30 kind of, first it's a B2B business you've seen. And still in B2B, you saw companies like SRF and Schaeffler getting valuation. But if this company has to re-rate, all these things will get discussed among the institutions. So it is important. So make note of these things, because we are going to see how each of these investments have performed. Now, so you got a fair idea of the business, how it is there, how it has come, why it has come, the business segment. Will it continue in the future? So if we look at where they are looking to invest, so few keywords are important. Good inquiry bank. So because these industries, they say from their cash flow, and that is how they have maintained good cash flow, and they selectively target municipal projects. So there are certain competitors, Wabag and all. If you look at the financial, you will be able to differentiate. There is a big difference. And the difference has come, I think, because Wabag focuses on any kind of contracts where they have been very selective. But we need to track, because going forward, because we can see there is a working capital pressure. They're telling selective, but are they living up to it? And chemicals, they have improved both the export volume and the domestic market share. And this business is very, very important. Consumer, they say, but don't give much importance. Now, if we look at, so this is more like a broader strategic agenda, but if we look at in terms of how they are thinking, what is the market size opportunity, can they do it? So these are more market potential. So the whole capex on the water, there are some data 2 years back, which was set to increase by 83% in next 5 years, which is almost a 15-16% kind of CAGR. Or if we look at the water treatment sector right now, only 37.5% of water is being treated, because government may not have funds, because this is done through municipals and all. But if country does well, they will increase the target. There is an opportunity which can happen. And then the per capita water availability, because of water crisis, it is going to go down further, which means you need to do more and more of recycling as a nation if you want to provide water. So these are the opportunities in various areas. Then there is a Nal Se Jal scheme where they want to provide so much of households. So these are the opportunities. In terms of industrial, only 60% of industrial water is treated. And if there are regulations which come that you have to mandatorily treat, and there are regulations coming like new plants versus old plants, some things are happening like within 5 years, you have to, meet those norms. So these are the opportunities which are happening. Plus, whenever India is growing the manufacturing story, so whenever new plants will open, they will have to do. And these 40% also needs to convert into next 5 years. So the expectation is to grow with the capital expenditure CAGR of 19.5%. And then there are Namami Ganga projects and all, where water cleaning and all is required, which is a separate market. And chemical industry, global water treatment chemical market is projected to grow at 9.3%. So this is the global number. So when you look at the Asia Pacific numbers, this will be higher number and all. So again, double digit. If industry can grow in double digit and they can grow higher, so again, and a lot of players are there. So in engineering, you have Thermex and all. I have a separate some documents I collected. I will share the names. So I have market share wise who is there and all. But more in terms of, so this gives a market size opportunity. Now, how the company is doing. So if we look at the last 1.5 years of order book, this is March 2021, where they had almost 662 crore order book, which excluded the Sri Lanka order. This was 400 crore. So almost 1,000 crore order book, because this is a very big order book and, you know, Sri Lankan issues, so tracking separately, and a 6,000 crore pipeline. And there is one more thing, as the size of the company is increasing, they're executing more orders, becoming bigger company, they might have a better chances to convert their pipeline. What I was hearing is earlier they used to convert 20% of pipeline. They're expecting that conversion rate will increase. So questions are, how are they improving their pipeline, how they are improving their conversion, and then how the final order book is improving. So their pipeline in last 1.5 years has gone from 6,000 crore to 8,000 crore. They are telling the conversion ratio will be better, and the actual projects which they have won. So this also gives an idea of how the pipeline is moving and how the order book conversion is moving. So from 662 crore order book, they have gone to 1,300 crore order book in March. And now from 1,300 to 1,267, they're at 1,530 crore kind of order book. So almost a 2.5x jump in the order book in last 1.5 years. And then the Sri Lankan order, as they're executing, it's decreasing. And then there is one more order they got from UP. So these numbers exclude the UP. So in UP, they have almost 1,100 crore order book. So basically, if you add this everything from almost 1,000 crore order book, they are almost at a 2,800 crore of order book, which is almost 2.8x. And it takes them average 2 to 3 years, depending on projects, to execute these order books. So this is how the order book will be distributed, and how the order book, new order book will keep getting added. That will decide the fate. But looks, that is why, you know, the interview was where they gave a 40% number. That was a very difficult number to digest, but this is how it is happening. And if everything goes fine on the UP side, Sri Lanka side, you know, things will happen. Now, they are saying they are witnessing robust order flows, both domestic and international market. Regarding Sri Lanka, so there are issues going on. It's a slow pace due to current political uncertainty and commodities shortage. UP, as per them, it's going fine. Then they are telling that because these new orders are coming, they have to strengthen their infrastructure, their team, and they're telling a part of the margin fall has happened because they're investing in building those infrastructure design teams and all to execute the huge order book. And there's a commodity pressure, and both of them are contributing to the margin fall. Chemical, it is going good, but in terms of margin, you saw in chemical also there is a little bit of margin fall which has happened, and they're telling that has happened because of the sharp US dollar fall. So currency, I'm just highlighting what could be the risk. So raw material is a risk, these kind of government projects is a risk, or country risk could be there, or currency could be a risk. Consumer looks like they're again telling, I don't know whether it will happen or not. It's a 10-year, nothing has happened. Now, if we go through the con call, so there is a substantial order book which we need to execute. We'll need these teams to work in parallel, and his requirement for improving the internal infrastructure, and that is one part of margin. The capex which they're telling, so there is a capex which is supposed to come, but that capex needs approvals, and it has gone into a little bit of delay. So the capex plan stays on course, where we have long period of vacancy. Some approving authority, no post was, no guy was there. Now that guy has come. So they are telling that they will operate this for the chemical business. There is 200 crore of capex which is coming for chemical. And you can see right now what kind of margins chemical has, and that's a big investment which will happen in chemical. And still they're telling they have a lot of headroom for expanding revenue in chemical division even in next 2 years. So from a margin perspective, so the margin, as you saw right now, margins engineering 5 years it went from 3% to 10%, and last 2 quarters has fallen to 6%. So how should we consider going ahead? Full year we are guiding, and they're guiding for a 10 to 11% margin. So they're telling 2 to 3 reasons. One being we have strengthened the infrastructure because of this order backlog. So this is more like a current investment, and hence the margins are down. It is hitting the bottom line. They're no longer so in coming quarter because of corresponding, and they're telling slowly those order books will be executed and those will come, and that will hit. The second is, so input cost is a thing. it's not, they cannot pass. If there will be an inflation input cost rise, their margins will go down. And all of that delivered. We use invoicing in coming quarter. We expect a significant improvement in engineering revenue. So they are telling because of revenue, more revenue coming in, operating leverage, the raw material margins improving, and all the investment which they have done to drive this order book. They're telling that all of this will lead to margins going back to the similar to what they have achieved in past 1 year. But this is something which needs to be tracked closely. Then in terms of growth and all, so this is growth trends which we have seen in first quarter. They're telling this growth will also continue, and we have order books there. The only thing is commodity prices. If this goes haywire, so with small caveat of commodity prices, they are expecting that they will again go back to the margin. And private, they were asking questions around how much of this domestic overseas. So export is 30%, and that is where even the current number is 30%. There are certain things I have not studied in detail. So green hydrogen is an opportunity they're discussing. Right now, it doesn't contribute significant way, but we need to study if this is something which could become bigger in coming years. So these are areas which we need to study. And private versus municipal. So as I said, it's very important to understand. And is it shifting more towards private or more towards municipal? So right now the private is around 40-50%. But I think from a working capital perspective, we need to track this and ask these numbers in the con call. And yeah, so same growth. Now in terms of growth, so somebody asked chemical will grow more, or the engineering will grow more, and they're telling engineering side we have a good order book, and chemical also they're expecting. Both have grown at same pace, but this big investment is happening in chemical, but it will take 2 years. And the volumes have improved substantially over a period of next 2 years, but we are also expecting engineering. So they're telling both will grow. But remember, chemical will have a very better margin, so that will contribute higher to the profitability. So all these things then there are certain products which are not contributing to profit margin. They're telling that will also start contributing, all of that. And this is the 200 crore of capex, which they're telling it will happen in 2 phases, and they plan to take it to stream. But there is a bottleneck of those regulatory approvals, and also that needs to happen. And I did those number crunching, as I was not sure if that is the right way, and they are also telling that the stable EBIT margin. So I did at an operating margin level. They have done at a EBIT margin. So my numbers were 31% right now. They're telling at an operating level, their EBIT margin in chemical business is 22%. So somewhere it validates that, okay, the analysis is correct. And 8,000 crore order book, significant portion is international. We hope that we are able to convert. And somewhere they have said that we are expecting a good conversion rate improvement also. So all of this. Now the Sri Lanka, because of the volume growth may not have happened. So one, they're highlighting that US-Europe issue. There could be a little bit of pressure on the chemical business side because of US and Europe, because they exported. But still they're telling that they're expecting businesses to grow. And a bit of certain consumer products we are here. So consumer business, it has not done well, but they're telling that they're coming with new products and all of that. So 40% Indian market share and all of that. So a lot of positive vibes with little bit of caution on India, Europe export, and little bit of caution on how commodity prices will move. So they are very gung-ho, and that is why maybe they gave a 40% number. The order book is there, but let's see if they're able to execute, and will the whole Europe recession is going to change things. I think these are the things we need to track. And they're telling we will be able to certainly improve margin significantly in coming quarters. So they're taking this 2-year quarter numbers were a little bad on margin front. And yeah, this is the clearance. Now risk part. So now there are a lot of points I discussed. What happened to those investment? The margins have improved. It has fallen. Is it sustainable? So now in risk, we will address each of those, and we'll try to understand, So first, the investment part, that 268 crore investment. And if you see, these are the places, lot of subsidiaries first. So it's not a easy P&L balance sheet to understand. Lots and lots of subsidiaries. And good investment has happened, that 268 crore. And nothing is profitable. So basically, if they get rid of all of this, their profit will increase. and some 270 crores has been invested, which is again leading to losses. So question comes, is it a genuine business effort to create new businesses, or they're trying to earn through this, through maybe having salaries there? I have not gone through the financials, how much they're earning in each of these companies as the salaries and all. So somebody needs to ask some hard questions, that why they're doing it and where they have gone wrong and what is the future plan. So one interesting thing has happened on consolidation of all the subsidiaries. I don't know if it is a management change to be more professional, more transparent, and they're telling that that work of consolidation is going on. So hope that happens, and I believe that will improve. I'm sure institutions who value these kind of companies, these are the factors which bring down the valuation despite of a lot of good things happening. So this is the red flag area, and we need to track if that consolidation is going to help it. Are they going to further invest because they will keep getting more free cash flows? Are they going to again do it here? Why they're doing it here? These are the hard questions, and nobody asks these things in the con call, but we need to see. I'm planning to attend and ask some of these questions in a soft manner. Again, this is all the investment amount, and so many companies, just see the number of companies. And I've tried to go company by company and some of the significant companies. So let's say this 30 crore in water care, aqua investment. So if we see where is water care and aqua investment and all, we will have it somewhere. But thing is, everything is with respect to water to some other country, but they have not done well. They are not creating profit, or that business is there, it's just lying and nothing has happened. Like this for Middle East, not much has happened. For IRCTC tie-up, they have created a company, all those things. But now the thing is, with that comes related party transactions. So once you did a lot of investment and you are not creating profit. Now with those investments, now with those entities, you are doing related party transactions. So again, huge long list of related party transaction. Again, so much of sales of goods. I hope it is on arm's length basis, but we need to go through those subsidiary financials and understand what is happening. But few key things I found. See, provision for doubtful debts, and these are debts given to these subsidiaries, and then those debts defaulted. So why are you investing? Why are you giving loan when those businesses are not doing well? So 10 crore, and imagine on a 5 years back, their profit was hardly 40-50 crores. So these numbers could be very high. So these are areas of, and that is why I said there is a part of business which is very interesting, and there is part of business which is very worrying. And that is why I highlighted that the conversion which has happened from a professionally managed company to an employee trust to a family which manage. And these are the hard questions which one need to ask. Then a lot of interest paid on ICDs, whether these ICDs given on an arm's length basis, so much of loans given to each of these companies, and we know these companies are not performing. So why are you giving all these loans? Then there are corporate guarantees given, and there is a commission on those corporate guarantees. So the RPT doesn't give me confidence, but then despite of all of this, the business has done so well that it has created a lot of wealth. But from an intent perspective, transparency perspective, premium valuation perspective, I think these things need lots and lots of cleaning. Also, when you read, so I read annual reports for last 11 years, and I especially focused on the years when they have not done well. So if we go to the screener, this is Ion Exchange. So you can see the good part is, if you see 10 years of data, 608 to 723 growth. This was 1 year when they didn't grow. And then again, growth. Very consistent, except this 1 year 14, and 10 was also not so good. And if we look from a margin perspective, 4, 5, 6, again this year because of revenue fall, and then 6, 7, 7, 8, 9 consistent. So there are 2 years, 2010 and 14, where some bad things happened. So I thought I will specially focus, because those are the places where you know what went wrong. So though it's very, very old, still I have tried to capture it. So commodity pricing, and you can see right now also they're talking about commodity pricing risk. So of course, inflation, commodity price, it's a B2B business, not very, not like where they can protect their margins like a consumer business by passing every 2 months. So commodity price is a risk. Export is a risk, because sometimes some country will do well, and despite of that, they've grown at 8-9%. But why you will see a fluctuation? So some years when you do very well and then you don't do well. always some country will not do well, and those kind of things will be there. Then in engineering, if they do delays, so margins were eroded due to unanticipated cost overrun. And remember, even with the UP government, they're telling the revenues are realized as project progress. So if you see accounting of infrastructure projects, you don't get cash, but you realize the revenue. Now this company has a very decent history, cash flows, but there were years where some projects went bad. I believe most of these projects will be with municipals, because that is where, you have to compete, and then, very tight margin, and then your plan goes wrong. So that is why we need to focus on the municipal, and these kind of risks will be there. Consumer business, they are telling it's a cutthroat competitive business or ever change margin. They have not done well. And I showed you in chemical last quarter, they have told because of currency fluctuation, margins got impacted, and this is from 2010. So fluctuation in exchange rate has been, so somewhere hedging also, though they say they have done, but these are areas which contribute to risk. So these are the key 4-5 risks apart from the corporate governance, related party transaction risks, which we need to be worried. Now the big thing, Sri Lanka, what will happen? So what they're telling is they will get, it's protected through some kind of credit agreement with Exim Bank. So can be claimed by the company from the water board as per contractual condition. So as far as overstay cost is concerned, it will not impact. We remain hopeful that in short period of time, we'll get necessary go ahead from Sri Lankan government funding agencies to start execution. We don't expect any loss arising from it because of those costs are not going to be lost. They say it's sponsored through Exim Bank, and that is how they will not. But again, these are risks. We don't know if that will happen or not. And again, raw material price and all, and how the industrial segments, each of these segments do, it will have an impact if more plants are opened, more manufacturing plants are opened. So of course, it improves the prospects for them. Yeah, that is where they're saying, and this project is funded by Exim Bank. So to that extent, credit risk is not something which is on top of mind, but somebody who is in banking, who deals, he can say how much we can trust on this statement. And this is the year 2013 when they gave 15%, no, 2014, when they gave a 15% growth outlook, because they have given a 40% number. So I wanted to check how they have done in the history in terms of promise. So 2014, they said they should grow at 15% and focus on advanced treatment. But again, if we go and see, in 14, they told 15%, but they didn't grow with 15%. In fact, no growth at all. And then they have grown at 9-10%. So same 9-10%. So again, their growth numbers, I will take it with a pinch of salt, because historically the numbers they have said, they didn't do it immediately, and even in long run they never achieved 15% kind of growth rate.